Diane Camacho is founder and president of DLC Consulting Services. Diane has spent more than 30 years as a legal manager in firms of various sizes. She started DLCCS in 2013 and has consulted with small firms around the country on a multitude of management and operational issues, including law firm startups. She speaks in the legal community on issues such as operations, IOLTA accounting, legal software, and starting new firms. In addition, she teaches law office management at San Francisco State University. Diane is a certified legal manager and holds a degree in organizational behavior and leadership from the University of San Francisco. She has a passion to help attorneys and their staff become more efficient. She believes attorneys should practice law, not spend their time in the weeds of running their businesses. Her experience ranges from office build-outs and moves to new technology implementations and law firm startups. Her email is diane@dlccs.com.
Thank you, Robert, for the introduction. I appreciate it. Thank you for having me. Today, I'm going to talk about trust accounts. And some of this is focused a little bit more in California. There's a couple of reasons for that. One is California just rolled out a program in the last year and a half that monitors the trust account and has the attorneys in California certifying that they are following the rules. And I expect that this will happen in other states as well. So I'm going to kind of go over that just very briefly with you. And another reason is because I do a lot of these in California. So although this is for any attorney anywhere in the United States, there might be some things that are just targeted to California. Bear with me. So trust accounts, one of the top reasons that attorneys are reported to the bar and disbarred. We have to remember that this is not the firm's money. It is also the accounts, the interest on the accounts is not the firm's interest. We have to document and we have to reconcile monthly. Those are the primary tenets of a trust account. And you can see that this is all over the United States. This is very recent. People are getting disbarred. In California, there was a gentleman that got caught stealing, I don't know how many millions of dollars from trust accounts. And since then, you can see that there are 1,600 attorneys that were suspended for violating the trust account rules. It's happening in every state across the United States. It's not anything that's unique to one state or another. The rules that guide trust money, there is a Rule 1.15, safekeeping property from the American Bar Association, and there will be a similar rule in every bar association in the United States. Either they're going to refer to the American Bar Association rule, or they're going to have their own rule that basically restates it and gives you more guidance on it. Also, in California, there is a rule in the rules of professional conduct. So this is the business rules. And I would imagine, again, that there are similar rules in other states throughout the United States. This isn't just attorneys that manage client funds, but other industries that manage client funds or individual funds. So we're all beholden to these rules. Now, there's two different types of trust accounts, and I kind of commingle them, but I want to make sure that you understand the differences. There's a trust account, and then there's an IOLTA account. And a trust account is typically one individual client. You have an estate that is being distributed, and the money for the sale of the house has come to the attorney to hold until settlement. That could be hundreds of thousands of dollars. That would be an individual trust account. That would in this instance, it would have the tax ID for the trust, I believe, but it would have the client's tax ID on it. The client gets the interest on that account, and it's typically large amounts that you want segregated. The IOLTA account normally houses money from multiple clients. And this is the account that the state bar, no matter what state you're in, the state bar tax ID number goes on this account. The state bar gets the interest. Again, in every state that I've ever worked in, which is a lot, this is the case. And I believe this is the case in every state. Normally it's smaller amounts. It's your retainer, it's your advanced costs, things like that. It's much more active. The account is much more active than a traditional trust account for one client. So those are the differences. The rules are normally written for the IOLTA account, but should also be adhered to for any trust account. So anytime you have client money. So IOLTA stands for Interest on Lawyer Trust Accounts, and it's a method of raising money for charitable purposes. So this means that the state takes the interest and they support normally legal services for indigent clients, and they have certain charities or legal services that they fund through these monies. So each individual state wants their own trust interest. So there's the rules that you are receiving are for the state of California, and as we'd expect, it is very long. I think it's 40 something pages. Other states don't have a handbook. They might just have a few words or a few directions. Some of them, other states have handbooks as well. But I'm giving you the California handbook because it seems to be the most thorough. And if you're following the California state rules, you're most likely going to be in compliance with every state in the United States. What the state of California did was it set up new rules, new regulations, but what it's doing, it's set up what they call a CTAP. So it's a Client Trust Account Protection Program. And what this means is you have to follow the rules that are in the guidelines. And then at the end of the year, when you're renewing your bar dues and your bar association membership, each attorney has to go in and certify that they understand the trust account rules and that their firm is adhering to the trust account rules. Now, I'm not going to get into how you do this and all of that kind of thing. I just want you to be aware of, if California is doing it now, you can be assured that other states are going to be doing it as well going forward. So just be aware of the fact that it's not only for the accountant, the bookkeeper, the office manager to know these rules and the managing partner to kind of understand them. Everybody in the firm really needs to know what these rules are. Every attorney in the firm is, in essence, touching attorney trust money when they are working for clients that have money in the firm trust account. So this is, again, part of that CTAP. So they're saying that even though you don't work, basically what I said, even though you don't work with the trust funds, you're maybe not in a position to touch the trust funds, you're working with clients that the firm is holding trust money for. So it's your responsibility as well to make sure that your firm is adhering to the rules and regulations. The only attorneys in California that are not required to certify that they're following the rules are the attorneys that aren't entitled to practice law or not on active status. So these are the people that have already been disbarred because they weren't using the proper trust account practices. So we're going to talk a little bit about the interest again on trust accounts. The interest goes to each state. if you open a bank account with a bank, so you're starting a firm or you're changing banks, and you go in there and you say, I need to open an IALTA account, a trust account for my clients, and the interest needs to go to the state. If the people that you're talking to don't understand it and can't explain it to you or set up the account properly or whatever it is, if they're like looking at you with like a deer in the headlights, go to a different bank. In California, there are banks listed that are approved of, if you will, to take money from law firms in trust accounts. So if you're questioning whether your bank is a good bank to do that, to handle your accounts, including your IALTA account, you may want to check on your bar website. Maybe they'll give you some guidance. Maybe there'll be some firms that they've kind of approved, if you will. If your law firm is operating in more than one state, and I'm not saying that I'm in California and I have an attorney working in Texas. That's not what I'm talking about. What I'm talking about is I have an office in California and I have an office in Nevada where I have attorneys working on matters in Nevada. They don't have to be, they could be California cases, but they're working on cases in Nevada. They're taking cases. They're operating as a law firm in Nevada. And this is something that you have to decide on. There isn't like, well, if you're earning more than $100,000 in a different state, you have to do this. But know that the states, if you're operating in more than one state, each state wants you to have your own IALTA account for that money so that they get the interest on it. So you can't have an office in California, an office in Nevada, an office in Texas, and an office in Georgia, and have all of the trust money come to California. Each office has to have its own trust account. Again, the state bar, the interest is used by the state bar for indigent clients. Don't use an online bank. You should use a bank that has a brick and mortar office within the state that you're working in. A client should evidently be able to go up to the bank and ask about it. They can't really withdraw money, but if it's a trust account and it's their tax ID, they certainly can get the money out. But you have to have a physical office. I had a client who was banking with an online bank. I don't remember what it was called. I had never heard about it before. However, when I looked at their bank statements, I noticed that the interest wasn't going to the state bar. The interest was it was coming back into that account. And the firm's tax ID number was associated with that online bank. So they were completely out of compliance for that. And they needed to get a bank that had a branch in California and they could open up an IALTA account there. Again, if you're holding large amounts for a single client, it should be in its own trust account. Now, this amount of money is really determined by if your client is asking for it. So your client says, this is, $500,000 and I want interest on it. So I want you to put it in an interest bearing account and I want the interest on it. Or if the firm decides that this is enough money that we want to segregate it. Now, in the 80s and 90s, my firm had a $10,000 amount. So if they were holding money more than $10,000 for a client, it went into an individual trust account. That's not realistic now. As we know, sometimes our retainers are more than that. And the interest rates are so low, people don't really care as much. In the 80s and 90s, there could be substantial interest earned on $10,000. So this is really determined by the firm or the client. The law firm's duty. You're required to separate your firm funds from your trust account funds. This also means that if you have a link on your website for clients to pay their bills or make deposits into the trust, replenishing their trust, they should be two different accounts. I'm sorry, two different links. If you have your money going into your operating account first, but it's really trust money, that's in violation. You can go in every day and transfer it every day and say, well, I'm in compliance. Well, yeah, you're in compliance, but that doesn't make any sense. You need to have two different links on your website, retainer and operating, or you don't take retainer replenishments on your website. You send a link to them with the invoice saying this needs to be replenished and this is the proper link to use. So you should not be depositing trust money in the operating account because it's more convenient for you or the client. That's not a good enough reason to do that. Also, if you have a check and it is partially yours, partially the client's, and partially the opposing party, it must go in your trust first. And ideally, you should be writing checks out of your trust account to each individual person. You should not be transferring the amount into your operating account because you don't have checks for your trust account and then distributing the money from your operating account. It should all happen in your operating account. And we're going to look at some reports later, and you'll kind of get an idea of why it's helpful and it's better for record keeping to keep these very separate as well. Find the right bank. We already talked about that. You have to be able to, at any time, present or produce a client ledger card. And again, we're going to talk about the record keeping later, but that's required. And you need to keep records for 5 years after the disbursement. So for your IOLTA account that's coming, client money is coming in and out and in and out, you're going to keep those records forever. But for your individual client trust accounts, you want to keep those for 5 years. Now, one of the other things that I like to mention as a best practice is downloading those bank statements and saving them somewhere, because you won't have access to the bank statements indefinitely for your accounts. And if you get audited for 7 years ago or 5 years ago, you may not have access to those bank statements. And that's going to be a problem for you. So I recommend that you download your bank statements. Since now everything is electronic, you download your bank statements and save them somewhere so you can have your bank statements for all of your trust account. Well, for all of your accounts, but for your trust accounts in a certain place. So just keep that in mind. And you have to keep the records for 5 years after the disbursement of the funds. You must reconcile monthly. That's it. You must notify a client of a receipt. Now, if you're taking money at the reception desk for a new client, you hand them a paper receipt. Usually it's a duplicate copy of a receipt and you hand it to them. If you are taking money electronically, you can, the client gets a receipt from the credit card company, but when talking to the State Bar of California, their opinion is that that's not enough. That is not the law firm telling the client, we have your money. It's the money got taken out of their account and the credit card company took it, but it's really not a receipt from the firm. So you need to notify the clients. And I think it's within 30 days. It depends on your state. But, simply sending a thank you email is enough of a receipt, but they should know that you physically have the money in your bank and you're holding it for them. So what goes into an IOLTA account? Retainers. Now there are rules about the amount of retainers and whether they can go into your operating account or have to go into your trust account. So you're going to want to really understand your state rules about that. California's just changed and allows you to put all retainer money into your operating account if in fact you make that statement in the engagement letter with the client and the client acknowledges it and can say, no, I want it to go into your trust account. Again, best practices, why would you want to spend the money before you earn it by putting in your operating account? That's a management decision, but you can do it if in fact you follow the rules. But typically, and best practices, all retainers to go into your IOLTA account. Settlement checks, as I mentioned earlier, all settlement checks must go into your trust account and be dispersed from there. Cost advances. Sometimes you'll take a cost advance retainer, or you'll say, I want, you have to pay for the filing of the complaint and the expert in advance. That would all go into your IOLTA account, and you can write checks out of your IOLTA. When does it come out? When it's ordered by the judge, when it's earned by the law firm. Earned does not mean you've worked the hours. Earned means you've worked the hours, you've billed the hours, and the client has no disputes about that bill. So, best practices, you send out your bills by the 5th, and in your engagement agreement, you tell the clients that you will be withdrawing money from the trust fund on the 10th or the 15th. Usually it's 10 days after the bills go out. And then you make one pull on the 15th of the month for all the trust money. That's when it's earned. You should not be looking at your trust account or looking at your bills and saying, I've worked 40 hours on this case and I have money in trust and I have payroll due on Friday, so I'm going to pull that money out of trust. That's borrowing money. If you have to do that, you need to issue a bill for that immediately before you take the trust money. And you're still a little bit in violation because you didn't wait for the client to dispute it. But now with a lot of the practice management software, they're allowing us to apply the trust as we're billing the client. However, you do not get to estimate how much money you would get because you've worked those hours. If you have cash flow issues and you need to do billing twice a month, then that's what you do. If you need to make sure that you're getting enough income to make payroll twice a month, then do billing twice a month. The A through the M's are the 1st and the N's through the Z's are the 20th, whatever, but you can't get it in advance. Bills have to go out, and technically you're to wait until the client disputes them. When a new firm is retained, you have to give the remainder of the retainer to the new firm. You can give it back to the client. If the client says, give the money to the new firm, you can do that. Otherwise, normally the check is issued to the client and then they give their new firm whatever they are requiring for a retainer. And at the end of the case, and this is also sometimes where we get in trouble. We don't pay attention to this. And we've got a case that's closed and it's been closed for 5 years and there's $325 left in the account. And now you can't find the client. And now what do? Well, now that money has to go to the state as unclaimed funds, and you have to go through all of that process. Again, best practices at the end of the year, one of your year-end closures is to look at all the trust account money and what clients have, what cases you finished that year that have trust money in the account, and send it to them. So at the end of the year or in January, everybody that has money in your trust account that you're not working for anymore gets their money back. Needs to become a routine. It needs to become part of the process. I can't say this enough, and I can't stress it enough. You cannot borrow and you cannot commingle. Commingling is taking the money that you've gotten for a settlement and putting it in your operating account first. Or not taking the money out of the trust account timely. Again, I've had clients who, let's leave the money. Well, I'm just going to leave the money in trust. I don't really need it now. I'm just going to leave it in trust. No, that's commingling funds. That trust account is only for client money. If you need a savings account, open a savings account and put that money in a savings account. Don't commingle your funds. That's either way. Don't leave the money in there if it's yours. Don't put the money in your operating if it's not. And we talked a little bit about borrowing. Oh, I'm just going to take a little bit out and then I'll put it back. Nope. Paying expenses with your trust account or your IOLTA account. This needs to be explained, again, needs to be explained in your engagement agreement. Everything that has anything to do with money really needs to be outlined very clearly in your engagement agreement. So you need to make sure that that's outlined. The other thing that I've seen that is very difficult to manage is paying all of the expenses out of trust for a client as they come in. So you get a bill for the process server and you write a check out of your trust account to pay that process server. You get a bill for a filing fee, you write a check from your IOLTA account to the court. You have to reconcile your trust account and it can be audited. And the more activity you have in your trust account, number one, the more mistakes are made and the more difficult it is to get audited. And if you get audited by the state bar, you have to pay for the audit. So you want that to be really clean, neat, and very streamlined. So my recommendation is you don't take money out of the trust for one client more than once a month. So if you're going to pay expenses, you make the withdrawal from your trust once a month and pay those expenses, or you pay those expenses and reimburse yourself once a month. Your trust account, again, is not a cash flow management tool. It is to hold client funds. So if you don't have enough cash to pay for your expenses on the case, you need to look at other areas. You don't want to constantly be making small withdrawals from your trust account for your 40 different clients. It gets very messy and it invariably does not reconcile. Reporting. This is one of the ways that firms get in trouble as well, as they're not adhering to the reporting requirements. And now many of the practice management and financial management software, the cloud-based software, is doing this for you. However, surprisingly, some are not. I was working with a client within the last year, and the program that she was using for her time and billing could not print out a trust report by client. So she's in violation. I wrote to them and told them that they were, selling a product in California that wasn't meeting the requirements, and hopefully they're going to address that. However, I've had to do that on more than one occasion for more than one software company. We can't assume that the software company is going to adhere to everybody's state laws and give you what you need for those. So make sure when you're looking at that, you're looking at the reporting and you're asking them to show you the trust reports. One of the trust reports you have to be able to produce is a ledger card or a ledger report that shows a zero balance and then the first deposit for that client, and then every deposit and every withdrawal for that client by the date with specific information and a running balance. And I'll show you an example of that. The other thing you need to do is you need to be able to show a report that is all the money in the firm IOLTA account and how much money is in each, it is in there on behalf of each client, and how much activity has happened for each client that month. Those are the two reports you must be able to produce. And a client is supposed to be able to call you at any time and say, how much money do I have in my trust account? I want to see a ledger. And you're supposed to be able to produce that relatively quickly. So this is the firm trust account. This is an example, and this meets the requirements in California, and I assume every other state. It does in every other state that we've worked in. You notice it's for the month, and it has the clients, and then it has the previous month balance, any activity, the date, and then the current balance. So the previous month balance, the current balance. So we show that this activity, they paid this invoice. We show they replenished it with $500. And so now their current balance is $905. And if we look down here, our balance is $3,155. This amount, this month-end balance, should reconcile with your bank account. One of the areas that we find that is not being adhered to, and I believe that it's because we've gone through very manual time and billing systems and financial systems, and the smaller firms are now going into the computerized systems. And when we were doing it manually, we had in some way a client ledger. Maybe it was a paper ledger and you wrote down every month what was happening for that client and what went in and what went out, and you'd add those up at the end of the month. But now with everything going into the time and billing software, and many times the finance software is in QuickBooks or Xero or something like that, you're having your bookkeeper reconcile your finance software, your QuickBooks or Xero, with the bank. And nobody is looking at the IOLTA trust account in your time and billing software. Well, your clients see your time and billing software. They don't see the QuickBooks account, and they don't care about the QuickBooks account. Therefore, your trust account must reconcile, your trust account in your time and billing software must reconcile with your bank account. If you're not doing that, you need to start doing that. And you're going to find 98% of the time, they aren't going to reconcile because we aren't paying enough attention to the trust activity in our time and billing software. This is the client trust account. So this is for one client. That happens to be me. I have client matter 57 and matter 75, and I've got an opening balance. Notice it's 0. You've got some funds in, one for each client. You've got, one for each matter. You've got money coming out. You've got a running balance, and then again, you have a balance of $9,200. This $9,200 should reconcile with whatever the current balance is for that matter on your firm trust account ledger. This all has to reconcile out. So as I said just a minute ago, this is where a lot of firms get into trouble, and it's a lot of money to go back and reconcile. We had a client who had changed time and billing software and changed trust accounts, not at the same time, over a period of about 10 years, and nothing was ever reconciled. And it cost them more than $10,000 to have us reconcile back to the beginning. It's very expensive not to reconcile your bank accounts properly with your time and billing and software for your financial information. It's very, very costly. It'll be costly because you'll be fined by the state bar, or if you're not doing it, it can be very costly to go back and reconcile it. However, you need to make sure that you're reconciled. So chances are, if you're not, you're going to pay some money to go back and reconcile it. The other place that you will notice if something is out of whack is on your balance sheet. So if we look up here in our assets, the IOLTA First Republic Bank, which isn't there anymore, we know in California, is $57,000. So this is an asset. Below the line as a liability is the deposits that you have on behalf of the client, and that needs to match. So if you're looking at your balance sheet and your deposits and retainers is $40,000 and you have $60,000 in your IOLTA account, then things are not being coded or entered, or however you want to put it, they aren't being entered properly in your finance software. So this is a quick check again when you get your reports every month to make sure that you have a line above and you have a line below for your retainers and that the amounts match. Five most common mistakes. We've talked about most of them. Don't borrow money. Don't commingle money. Most of the time, this is happening because law firms don't realize that they're doing something wrong. The reason new laws are created is when those people that know that it's wrong and have some scheme going on, so everybody else has to follow these rigid guidelines. However, most of the time, I've never worked with a law firm that has known they were out of balance, has known they were doing something incorrectly when they were having us look at their trust account. But it's one of the first things we look at when we start working with a client and we're looking at their financials is, does your time and billing software reconcile with your bank, with your financial software? Fees. There's a way for any kinds of, first of all, you shouldn't have to pay fees if you have a lot of money in your IELTA account, but maybe you have to pay a wire fee or something, you know, bounces and you need to pay a insufficient funds amount. Those charges that your bank makes should come out of your operating account. And this is, again, working with the right bank. Now, there are some banks that are nationwide that don't allow you to do this, but I don't recommend you use those big banks, so I'm not going to say anything about it. But you should have those fees coming out of your operating account. You can have a certain amount of money in your trust account that is administrative fees or covers administrative fees. Now, if you're doing this, it could be $100. And if you're doing this, you should have a matter in your time and billing software that says administration and $100. So that, again, when you print out the firm trust account ledger, it has their administrative fees, $100, and all the client money, and it reconciles with the bank. So if you're doing that, make sure you create a matter and you just put the money in there under trust. And then if you need to, you can put money in and take it out and reconcile against it. It's up to you. If your account becomes non-sufficient funds, if there's non-sufficient, let me rephrase that. If there's non-sufficient funds in your bank account, the state is notified immediately. And that's how a lot of people get audited. So if you have a trust account that is, you know, that can go to zero or is not, you know, is a smaller trust account because of your practice or how you bill, then you're going to want to make sure that you have a little bit of cushion in there. And you're going to want to make sure that you're reconciling to the dollar, because if not, and you are in arrears, then the bar gets notified. There's a red flag, and I'm sure it's automatic electronically, and they get a list every month, and then they start going out and auditing. And it's really a pain. Even if you've done nothing wrong, it's really a pain, as we know, to deal with any kind of bureaucratic entity like the Bar Association. Trust account money is not income, and it should always be on the income and liability on your profit and loss. So sometimes they're accounted for incorrectly when you're setting up your GLs. Make sure that that's correct. And the other thing is the record keeping. Is not keeping track of what money you have and what you're using the money for throughout the month, and not being able to produce those records timely to the state bar if they're asking, or to your clients. So this is some information about me and my firm and what we can do for you. But I notice we have some time, and a lot of times this is for question and answers, but I've added a couple of extras to the slide presentation that I think is useful for law firms in general, primarily small law firms that don't have a lot of don't have a lot of guidance from people like me that are more expertise at managing law firms, if that sounds right. I don't know how that sounds. However, there's a couple of things that we recommend as best practices when we are working with law firms. And a lot of times we say, know your numbers. I'm sure you've heard that, know your numbers, know what your numbers are. And you're thinking, well, what numbers? Some people are like, well, your KPIs and, all of this kind of thing. It For us, your numbers include how much it costs to house and feed each employee. That doesn't mean just their salary and 20% for benefits and insurance. It really means now we have subscription-based software. So how much does it cost per employee to set them up? For me and my firm, it's about $300, $350. That's kind of what we mentioned. If you're in a completely cloud-based platform that's top of the line, that's about what you're going to spend. That doesn't necessarily include research, which is Westlaw and Lexis. So you have to include that. If they're in an office, you want to include that. If you're giving them any kind of stipend for their phones, if you are paying for their dues, if you're sending them to a conference, all of those things you can carve out and say, if I didn't have this employee, I wouldn't be paying that money. So that is what it costs me to house and feed this employee. And you can say, on average, it costs X amount of dollars above and beyond salary to house and feed an associate versus a legal assistant or paralegal or partner. But you should know how much what that number is. And you should actually also know what the revenue is that you're making on each employee or each case if you're doing flat fee. This is the realization. If you don't know how much it costs to house and feed, as I say, an employee, and how much revenue you're getting for a case or on a client, on an employee, then it's very difficult to decide whether you want to add people or reduce people or get rid of a practice group because it's not really the way that you want to spend your time and energy because you're only making 10% on this type of client, but you're making 40% on this kind of client. Well, obviously we want to go after more of these clients. That's your realization. And then the other thing that we like to make sure that our clients know is what's your cash position? How much money do you have to pay your bills next week? This is one of those things that we all recommend having budgets. We know we have to have budgets and it's recommended, but this isn't, being out of budget really doesn't keep you up at night. But worrying whether you have enough money to make payroll on Friday is going to keep you up at night. So if you have a way to quickly look at that and to get a report every Monday and know that you're fine, you don't have to worry about that anymore. So if we're looking at a realization report, this is a realization report by client. So we see that client 1, labor and employment, we had billable time, that was 15 hours. We discounted it this amount. So we billed $1,677. The client disputed some, so we wrote off some. So we collected $1,161. No expenses for this. And we can just go down the line and look at this. So our billable time was $20,000 and our billable hours were 103. We, however, wrote off time, didn't collect it all. So we basically collected $17,448. So if we look at it over here, We have discounted 10% before we even sent the bills out. And that means that you can only collect 94% of what you worked before you even bill it. So the billable amount was 20,000, you took off discount, the write-offs, you had $17,000 collected. So your realization ratio is 85%. We like to see this realization ratio at 90 or above. So you want to look at a couple of things. You want to look at your write-offs. Are your write-offs really necessary? Have your clients asked for them? Did somebody really overbill something? Really pay attention to this. We have clients that write off way too much money before the client even sees the bill. Think about whether that's necessary and whether you're just giving away good, hard-earned money because you're afraid your client won't pay it. And if those are the kind of clients you have, again, is that the practice you want to be in? You should really be making 90% of what's billed. If you have attorneys or legal assistants or whoever that you can't bill their time, you need to take that into account. Are they new? We had a client that we saw for one attorney constantly wrote off their time. And we're like, why are you writing off his time? What's going on? Well, he's new, so we're writing off his time. We're like, wait a minute, he's been here 6 months. Is he really new? Should you really be writing off that much time? So again, really looking at what your write-offs are and paying attention to that. I know a lot of people don't want to look at it. It's like collections, you don't want to, but it's important. Some firms do not allow, big firms do not allow anybody to write off anything that isn't approved by a partner. Some firms, associates are writing off time. So be very clear about that. If we look at the cash position report, so this is a nice firm. They have in their operating account $523,000. That's not usually what small firms have. We recommend that you have at least 2 or 3 payrolls in your operating account if you can do that. Some people can, some people can't. And then you have money in your savings account. This is not IOLTA. This is savings account that maybe you've put aside for your 401k, maybe you've put it aside for the end of the year distribution, whatever. This is your savings accounts that the account balance that you typically can take if you need to. And then this week we have payroll of 98,000. We have rent this week, health insurance, other miscellaneous AP. So the total AP is 153,000. We expect to bring in about $54,000 this week because we know the Brown settlement is due. You might say, well, on average, we collect $100,000 a week. So we expect $100,000. That's realistic. That's what you average, what you get average. So at the end of this week, after you've paid all your expenses and gotten all of your deposits accounted for, you are obviously in a good position. So this is kind of what makes you think about, oh, I need to draw from the line before Friday for payroll. You want to know this before Thursday when you're approving the payroll. And if you're close to the line, it's really nice to think about this, on a month basis, and then maybe break it down by the week, or maybe you do it the week before payroll, so you're doing it twice a month, and you're just being comfortable with what your cash position is. So this is a comfort report. And then the checks and balances. I have just a few minutes left, and I really want to stress the importance of checks and balances. We believe that the people that work for us are trustworthy. We may have been working with them for 30 years and know they would never steal from us or borrow money from us. However, we don't know. What if that employee has their child in the hospital? They need emergency specific procedure, and the hospital isn't going to perform that procedure if they don't come up with $50,000 and they have access to your accounts. We don't know what that person would do. We don't know if that person starts to have a drug problem and we aren't noticing it at work, but they are having a drug problem and they're running out of money and they're not making it from week to week. So they are now borrowing money from your account. We don't want to allow that. We don't want to give them opportunities for theft. A lot of money is stolen from law firms. I can't tell you how many times I hear about it, but we don't talk about it. It's a family secret. It's embarrassing. And we certainly don't want our clients to know that we can't handle our money. So don't set your firm up, don't set your employees up to take money. And the ways to do this, even in small firms, is a separation of duties. So the person that is sending the bills out should not necessarily be the person that is taking the money in and applying it to the outstanding invoices. If they are, there needs to be a way for the money that comes in to be seen by more than just that person. So in instance, the checks come in to somebody and they log the checks in and then give them to the accounting department. Or maybe you have two people in the accounting department and one person sends out the invoices and one person applies the payments. Or maybe the partners review everything that comes in from LawPay or your automatic pay links, things like that. You should always know all of your vendors. You should know if you see a vendor and you don't know what that vendor is doing for you, you need to know what that vendor is. It's very easy to create a vendor and start paying a vendor, and that vendor doesn't exist. Or it's that vendor that's, that's so-and-so's cousin. Look at your bank statements. Used to be, the bank statements would come in, they would go unopened to the managing partner, who would then open those up, review them quickly, identify what checks they signed, and then give the statement to the accounting department, and then they would reconcile. Also, having somebody outside the firm reconcile, or have somebody besides your accounting department reconcile. Or if you have two people in the accounting department, have one person reconcile and the other person taking in the money and sending out the money. You should never, I'm done, but I'm going to make this statement. You should never have a stamp for your signature that anybody can stamp on a check and issue it on your behalf. That's my last tidbit. Well, it looks like we have a few more minutes, and I wanted to go over some questions I commonly get either when I'm talking with clients or when I'm giving this presentation live. And one of the questions is around attorneys really, they practice law, they don't really spend time in accounting classes and don't really understand, the nuances of accounting. And what our recommendation is, should they be hiring somebody to do this for them? Should they be doing it themselves and training on it? How should they be handling this? This is obviously very important, and it's important to their livelihood, quite frankly. And what we recommend, and we understand that you don't have to really take a finance course or an accounting class in order to understand what you need to be looking for. But when you're looking for somebody to help you with this, and you're by yourself, or maybe it's you and your legal assistant and they're doing the accounts payable and the billing, but you really need somebody outside the firm to reconcile and to make sure that you're in compliance. That's when you would go outside of your firm and maybe hire a bookkeeper. Maybe your CPA allows some hours that they could bill you for separately, and they can reconcile your accounts for you every month. Some CPAs will do that for you. And then there are firms such as myself and our group, and we do back office bookkeeping. When you're hiring somebody like myself, you want to know that they have, in fact, experience with trust accounting. It's kind of like the bank. It's kind of like going in there and saying, okay, tell me about your experience with law firm bookkeeping. Do you know anything about trust accounts? And find out if they look like a deer in the headlight, or they talk to you about the separation and the requirements of reconciling and the importance of following the state guidelines. Make sure that they understand those things. A lot of times, small firms, solos, they know that their neighbor's wife is a bookkeeper. And they're like, great, I'm going to hire that person. But they've never done bookkeeping for a law firm. They don't understand client advance costs and they don't understand trust accounting. So make sure that you know somebody that either recommends somebody they've used, or you do a search, or you contact us, or somehow you find somebody that understands trust accounting and legal bookkeeping, and just ask them those questions. And then if you understand that you need to see at the end of the month a report that shows the activity in your trust account, and at the bottom it has a dollar amount, and that dollar amount needs to match the bank, then you can check that. So you don't have to get in there and understand about debits and credits and applying. You just know that the bottom line is this has to match that. And then that would be enough. The other thing is sometimes people are, well, we're really small. I don't have somebody to do that for me. I can't do the checks and balances kind of thing. Outsource it. It may seem like it's an expense that you're thinking, well, I can just do this. It's not, I don't want to pay that $600, $700 a month, whatever it is, a couple of billable hours. You want to make sure that it gets done. It gets done every month, and that it gets done right. And if you aren't going to make sure that it happens in-house, either you do it, sometimes small firm attorneys, they'll do it themselves. It's very important to them, and they track it themselves, and they're very good about it. If you're not one of those people and you're going to go, oh shoot, well, I have to reconcile the trust account this month, but I'll just wait and do it again, twice, do it next month for 2 months. That's when you have mistakes you cannot find. The longer you have mistakes embedded in your system, the harder it is to figure out what went wrong. If you're looking at 1 month and you know that you've had 25 transactions in and out of your trust account, it's pretty easy to reconcile that. If you're looking at 6 months and you have 25 times 6, it gets more and more confusing and convoluted to try and reconcile that. There was a gentleman that he's opening his own firm, and he's like, my mom's a bookkeeper and she knows everything about it. I'm going to have her do it. Well, I gave her some training on trust accounting. I gave her some videos. She and I had a conversation, and I felt comfortable that she knew what she was doing. He felt comfortable. She felt comfortable. And I felt like they didn't need somebody like me. If you have somebody that you need to have trained, talk to your CPA, have them take the MCLE classes. Again, have them reach out to us and have that person trained. If it's somebody like your wife and you really want that person doing your books, there is training out there for somebody. But if you're hiring somebody, make sure they know what they're doing. Another question that I get sometimes is, well, my clients, they just use the wrong link. It's just an accident. They accidentally put the money in the operating account. Am I going to get in trouble for that? Or am I out of compliance for that? Well, the rule is if it gets deposited, you need to transfer it into your trust immediately or as soon as possible. There's some vague legal term that is used. So you can't leave it in your operating. So that means that you need to be really paying attention to what money comes in and out of your account daily, if not weekly at the longest, and transfer that money over to trust and make sure it's very well documented that this was deposited in error by the client and transferred to the trust account immediately upon realization or something. And then in the trust account, because it's coming from your operating account and going into your trust account, it looks a little weird. You need to reconcile that. You need to identify that as well. There's software programs now that will not allow you to make deposits into your operating account if there isn't a bill that you can apply it to. So they're gonna say, what bill are you applying this money to? And you're gonna say, oh, shoot, it's trust account. It's not supposed to go in there. I need to deposit in my trust account. So the software sometimes has some fail safes in there for you as well, so that there's a realization of that. And it'll be sitting in a kind of a holding account until you identify it that those needs to go to trust. Those are kind of the questions. One of the things that we don't kind of take into consideration is if you're not really communicating with your client about the activity in their trust account, and a lot of times we'll have on their invoices, we'll have all the trust account activity either from the beginning of time or at least that month. That's a good way of keeping your clients informed about your trust accounting. So looking at your bill formats and seeing if you can put in the statement summary or something like that, depends on the account, that there is a formatting that you can check the box and say, I want the trust account activity to show up on all their invoices. They can make a claim to the state bar that you didn't give them their money back, or you kept too much of the settlement, or any of that. So you can get kind of reported from the bank or from a client. And we know what happens when our clients are dissatisfied with something that's happened. Sometimes they just want to retaliate. So again, if you're doing your documentation right and your client is aware of that, it makes everything clear and easier to reconcile and easier to justify and to show that you are following the right guidelines. And that's all the time we have. I hope that it was worth your time and that you've learned something today. Thank you very much.